Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Ray Goodletsky. He's with Southeast Wealth Partners and has spent 8 years in corporate America and had 10 years as a real estate agent, and then is currently a CFP and has been giving financial advice over the last 12 years. So, Ray, I am looking forward to our conversation today.
Me too. Thanks for having me.
Absolutely. Love to start with your background. And I always go way back to, where were you born and what eventually led you into this world of financial advising?
Okay. Yep. So born and raised in the Atlanta area, born in Northside Hospital. For those around Atlanta, they've heard of that one, also known as the Baby Factory. In Gwinnett County was where I grew up. Played 2 years of college basketball, got my MBA, not MBA, but MBA from Georgia State University, which is in downtown Atlanta. I've been a CFP for a few years and got in this industry. It's been 12 years. It's been fantastic. Had that light bulb moment happen about 12 years ago. I just knew it was, not quite where I needed to be, right? And certainly it was a grind in the early years, but, as I reflect back, very thankful for doing it. But yeah, I grew up in a realtor household, so I'm very familiar with, the world of being a realtor. And but when I meet with people, it's very helpful to be able to relate to them. So that corporate experience I had, I really enjoyed it, but it just wasn't in the cards to continue with that. And then on the flip side, being a realtor through 2008 was not a fun experience. So I've kind of seen both extremes, and that just helps me relate when I'm meeting with folks that come from different backgrounds.
Yeah, I kind of noticed as I was reading that off about the timeline and the time period that you've been in, it switched over to being a CFP, and, it kind of does fall in line. I, too, at the time was a full-time broker. It's funny, the other day I was having coffee with another real estate agent, and we were talking a little bit about that, and I worked for a company he used to work with, and he's like, "When did you leave there?" I said, "Well, it was perfect timing. I started my own brokerage in 2005, and just a couple of years before the big financial crisis." So, can't wait to just kind of go into and unpack some of the various ways that people can build wealth, but also manage the wealth that they've built over that period of time. So I know we're going to dive into a lot of subjects with respect to that. But I always like to start when I talk with a financial advisor, what are some kind of things that maybe when you got into this business that you started to see as you met with customers, met with clients, and you're like, hey, these are some things that seem to be fairly low-hanging fruit that they're not optimizing that maybe they could?
Oh boy, there's a whole list of them. So, when it comes to retirement plans, right? So if you're working at an employer, you want to meet the match as a minimum. That's a good goal. I like tax diversification. What I mean by that is, Because sometimes I'll meet with somebody and they're already 65 years old and they got all their money in pre-tax accounts, and very little in savings, maybe 100,000 in savings. That's not very balanced at all, right? And so there's not a whole lot of chess moves to be made when all your money, you just not, you kind of got a tax break, as they say, all on the way. So a couple things when it comes to working for the corporate world, at least meet the match. And I would say maybe get some diversification when it comes to get some Roth going, as well as some tax deductions. Again, this is kind of broad, right? So these are examples. Now, if you're a solopreneur, there's a lot of options, right? You could do a SEP IRA, you could do a solo 401k, or if you're a business owner, right, and you're doing really well, but you're paying a lot of taxes, then you want to start to explore perhaps a defined benefit plan.
Okay. Why don't we go into some of those on the specifically maybe the solopreneur, just kind of, if we could talk a little bit about that. We've got, I'm sure, a lot of the audience that may find themselves in that scenario where they're a solopreneur. What are some of the things that they can do to, best kind of protect themselves when it comes to taxes, but also to prepare for retirement?
Okay. Well, you did say protect. So just to kind of expound on that, life insurance is something that, if you got kids, right, got a spouse, you probably want it. You want to get it before you have a major health event. So you do want to at least have a good conversation around that. How much do I need? What type do I need? So you want to do that. But if you're a solopreneur and you want to do a solo 401k, what's nice about that is now you can't have W-2 employees, right? You can't have that and have a solo 401k. You can have a spouse in the business, that's fine. But you can put in a lot of money, right? So $24,500 as the salary deferral. And then if you're 50 and better like us, you can put in another $8,000. And then you can put in a profit share on top of that. So if you're having a great year and you want to put a lot of money away, say $50,000 or so, to reduce that taxable income for that year, you can do it. If you're having a terrible year and you don't want to put any money in, then you don't put any money in. From a liquidity standpoint, you can borrow up to half the balance in the solo 401k. So no more than 50,000. So the number there would be, once you get over 100,000, 50,000 would be the max that you could borrow against your solo 401k. Again, if there's a spouse involved, you could potentially, both of you could do that. So not tons of liquidity, but not bad, right? 50,000 that you're paying yourself back versus a bank, and it's not going to be taxable as long as you pay it back, and there's not going to be a penalty. Because I do see people liquidate 401ks and liquidate IRAs before they're age 59 and a half, and that can be painful.
Yeah, for sure. What are some of from the structure standpoint? Are there various? So when I think of 401k or retirement plans, a lot of times I'm thinking more corporate America, just because that's been my experience before was corporate America, and not having necessarily something set up when I was a solopreneur. So how does the 401k work there? I mean, is it a specific company that you're utilizing to be able to put the money into? Or
right. So if you're in the corporate world and you got a 401k, the company's really going to, they're going to have the rules around what is allowed and not allowed in the 401k. Yeah. So broadly speaking, the ones that are best for the employee would be ones that allow you to put a lot of money in there. So I'll give you an example. Again, any 401k plan, you can put in a $24,500 as a salary deferral, and that changes every year. All right. So in any plan, you should be able to do that. Now, is there a match? That's specific to the plan docs, right? So I've seen a lot of, hey, if I put in 5, I get 4, right? I put in 6, I get 3. So it just depends on the plan. And but on top of that, you get the catch-up provision. So if you're 50 and older, you can put in $8,000 as a catch-up. If the company does a profit share, then that's great. Some of them are not going to do that. But also, this is strange, but if you turn 61, 62, or 63, you could put in $11,250 as your catch-up instead of the $8,000. So only Congress should come up with something like that. Yeah. But that's, just a little extra there. Now, this is the year they're changing that the catch-up has to be in the Roth side if you made too much money the year before. So you got to keep up with all these rules. Or I have a front back PDF if you want to put it in the show notes. Certainly,
Okay,
I'll be
perfect.
happy to share it with you. But it's really cool. It's got all the tax stuff, the brackets. I'm single, I'm married. But getting back to the 401k, what's nice when you're an employer, you might be able to do a mega backdoor Roth. So those are pretty cool, but oftentimes you can't do it. So it depends on your plan that you're in. So the way to find that out, I think I actually had an episode on that, is you can, first they got to be able to allow what they call after-tax contributions. So the employer has to allow that. If they don't allow that, and there's a lot of plans that don't, but they do, then that's step one. And the other step would be, can you do a in-service distribution or a conversion, So, right, you're putting in the after-tax dollars, and then inside the plan, you convert it to a Roth. So that's a way you can get an extra 30 grand or so into a Roth inside of that plan. So those are some of the things, right, with the 401k. You got deferred comp and things like that as well.
Okay, no, that's interesting. And you said pretty well changes, all the time as far as the amounts. I guess those are what are adjusted most. But there's over 50 you can start to do in addition to the 24,500, 8,000 additional, unless of course, like you mentioned, it's 61, 62, or 63, right. And then it's 11,000 something.
Right. 11,250. Yeah.
Okay.
Yeah. And also, just to point out, most plans today will allow you to do a Roth 401k contribution. So what that means is there's no income that's preventing you from putting money into a Roth 401k. So you got to check the plan docs, but most plans will let you do that. Not saying you should, but you might consider that, especially if you're behind on having some tax-free money like a Roth. So you will not get a deduction when you put the money in it, right? You're not going to get a deduction, but what you will get is the tax-free distributions on the other end, assuming it's been invested for 5 years. So that's the,
okay.
And you can split it up too. Like, hey, I want to put half in the Roth and half in the pre-tax 401k.
Okay. No, very cool. How about, you mentioned profit sharing as one of the ones, and we were initially talking about a solo 401k.
Right.
Are you able to profit share within your company? And explain a little bit about how that works.
Right. So I think it's easier to explain for a solo 401k. So that's where you're the solopreneur, right? You could be a sole proprietor or you could be an S corp. Either one works. You can still do it. Again, you could have a spouse in the plan. You just cannot have W-2 employees in it. So you got the deferral pieces, which we've covered, 24/5 plus a catch-up if you're old enough. And then the profit share piece depends. Are you a S corp, which means you would have a W-2? So in that example, let's just say you had you W-2 yourself $72,000, right? So now you could put another $18,000. It's based upon 25% of your W-2 amount. That's how much you could put in. Okay. So if you made $60,000 as your W-2, then you could put in less, right? You could do another profit share of $15,000. That's going to come from the business account, right? Your business account would fund that. So that's how you would do it. Now, if you're a sole proprietor and you're not an S corp, you're going to actually be able to put more money away into an S corp, right? Or a solo 401k, right? Because you're not having that W-2 limiting how much profit share you can do. Again, not enough of a reason to, well, let me leave the S corp. No, because you're saving a lot of taxes with the S corp, right? You're saving about 15.3% with all your distributions that you get. So it depends on the situation, but once people are making $100,000 or more after expenses before tax, and you feel comfortable, confident that you're going to continue that track, I tend to see most people in an S corp. We didn't talk about C corps, but for solopreneurs, that's most common. Is I see S corps and sole props.
Okay. Oh, very cool. Good explanation too. And then you mentioned also. So you've got what about if you have an S corp or you do have W-2 employees? What are some advantages or ways that you can utilize some of these tools?
Yeah, so if you have employees, thankfully, because of softwares and technologies, the 401k plans that used to scare the small business owners, oh my gosh, they're expensive, they're administrative headache. I don't find it to be true any longer. And so you should certainly explore 401k plans. So if you have employees, now you can do it. And you typically would pick a safe harbor plan so that you can put as much in as you want, and you're not having to worry about, somebody, not following. There's, RISA comes into play, right? When you're doing 401k plans. So you just want to make sure that you are being compliant. So depending on who are you working with on the 401k side, they may be able to, some can do kind of a limited level of service. Some can do a higher level of service so that you can, maybe not have to do as much, but it is going to go through payroll. So you got to make sure, the entities are talking with each other. Okay, I'm taking that at a payroll. So, but that's just a way for the owner, if the owner wants to put that, yes, it's a retention, could be a recruitment tool, right? And so out of pocket, usually you're going to get an illustration that's going to show you what is the most, money the company's got to pay if everybody contributes, and I got to do some form of employer match to be in the safe harbor. And it's usually not that bad. And then the reality is, a lot of times the employees are not putting money in there, depending on the industry that you're in, right? So if you're sending out weekly paychecks, then that tends to be the little bit of a hint that they're going to be not doing the 401k.
Right.
But it's a great thing to have. You can choose to do a profit share or not. So if you do a profit share in that sense, the folks that put the money in are going to get some of that profit share, and the folks that don't put any money in, they're not going to get that profit share. And owners tend to get some. Now, if you're doing really good and you're like, hey, this 401k, it's really not doing much for me as a business owner. I sweat and grinded it out for years, and now I hit that inflection point. I'm making some really good money, and now Uncle Sam is not being very nice to me. What can I do? Right? I'm making $1 million, before tax, or $2 million before tax, or even $600,000 before tax. That's when you start to look at defined benefit plans to get in conjunction with the 401k. Now you can save some serious money depending on your age. So, we got some people in their 60s, right? And they're able to stuff away $400,000. They're reducing their taxable income by $400K. That's a big deal. So,
and that's called a defined
benefit
pension benefit
defined
plan.
Benefit.
Okay.
So defined contribution or 401k kind of plans, 403Bs, things like that. Defined benefits could be an old style pension, which for these closely held private companies is something to explore. That has to do with the ages and the income levels. So there's a couple of different things to analyze whether that's going to be right for you. So underneath the defined benefit umbrella, if you will, pension's one option and cash balance is an option. There's a couple of others, but those are the two that I see that are most common. Cash balance is a little simpler. Still, there's some complexities there. So you want to make sure, most accountants aren't going to fool with that, right? There's a niche market out there that, and we have someone that I'll partner up with. Say, hey, let's, get with the actuary. Let's do this cash balance plan. We got a company that would really like to reduce her tax bill over the next 3 to 5 years.
Okay. Yeah. Very, very cool. Great exposure to some of that stuff. And of course, we'll share at the end, how people can find out more about you. WealthFlow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. How about some of the other items? We've got obviously a group of folks that are kind of getting up to that retirement age. What are some things that people should be thinking about as they're, call it 4 years, 3 years away from retirement?
Yeah, I mean, if you're 3 years out from retirement and you've got all your investments in equities, stocks, things like that, you might want to take a pause and go, what am I going to do in 3 years? How much is my income going to be dropping? Right. So it really, I would say most people, especially if you're a year out, but even 3 years out, I would go, if you already have a person, great. Maybe they specialize in retirement planning. Maybe they don't. Maybe they're just more on the investment side, right? And which is because accumulating assets and saving is very different than taking money out of these accounts. It's a whole different skill set. So anyways, you would have I would say get a financial plan. Pay out of pocket if you need to, but go ahead and get and pay for our plan. Or maybe, who knows, you switch horses per se, and they also do a great job on the financial plan. So that way you can get into all the things like, what about Social Security optimization? Because if you're getting your advice from a reel or a TikTok on what to do about Social Security or what you heard at a barbecue, you better take it at 62 and invest the difference. That might not be the best thing for you, right? So, but that's just one of them. And how do you position yourself, so that you've got money that is going to be ready for you when you truly are retired and that income gets reduced, but you're not too heavy into being conservative with all your money, right? So that it's not even outpacing inflation. So it's really important to have a more detailed plan when you get there, so you can visualize it and you see it, and you don't freak out when the market goes down, when you're not saving anymore. Medicare surcharges, that's kind of a thorn in people's side. A lot of people don't hear about it until they get a letter. And they're like, 65, and they're like, wait, what? Why am I paying more than my neighbor for the same Medicare, right? So there's some planning that goes around that. And sometimes there's a situation that happens because Medicare, right, which is when you get 65 and older, is a 2-year look back. They look at taxes from 2 years ago. So sometimes you had an event that qualifies you to not pay more, right? Well, I retired. And so instead of looking at that, for this year, 2024 taxes, you retired in 2024, right? So you shouldn't have to pay, more for Medicare in 2026 when you're retired. So you just have to fill out a form, and now you can't, you still got to have a reduction of income in 2026. You're going to go off your 2026 income. So that would be one of the things. Long-term care planning, you got to think through that, right? Does it mean you need a policy? No, not necessarily, but maybe you want to explore it, right? So there's things with that. There's a lot. Roth conversions, right? Doesn't mean you should do it, but it might be good to do a calculation, because that main tax planning window that you have is between the ages of 59 and a half and 70. That's a great tax planning window before you turn on Social Security, before RMDs hit. Those are the two things. When those two things happen, you've got a whole lot less wiggle room to make adjustments to your planning when it comes to tax diversification.
Okay. You said a lot there, so let's unpack some of that. What are RMDs? What
Sure. RMDs are required minimum distributions.
Oh, got it.
So
Okay.
what that means is the government says, hey, put money in this 401k, put money in this traditional IRA. We're going to give you a tax break, right? And you get a deduction that year that you do it. And then it grows tax-free. And then you and Uncle Sam are in partnerships. So when you take the money out of those plans, out of those accounts, it'll be treated as ordinary income. Right. So it'll be taxed at whatever tax rate you're at. So, retirees are all over the place right now. I've seen some at 12%, I see some at 22%, 24%. I'm talking about tax rates, 32%, right? So RMDs just means that the government says, hey, at some point you got to take money out of this account. You can't just never take money out of that account. You have to take it out. It used to be 70 and a half for the longest time. Then with the Secure Act, they changed it. They actually changed it twice. It was 72 for about a minute, about a cup of coffee, and then they changed it to 73 for people right now. But starting in 2035, if you're not 73 yet, then the age will be 75. So for like you and I, our RMD age is 75. Could they change it? Sure, they could change that. But for now, and what that'll mean is there's going to be a calculation in those accounts that you got a tax break on. Those deferred taxable accounts, you're going to have to take a minimum out. So year one, typically speaking, you're going to be under 4%. That's what they're going to make you take out. There's actually a formula on there. That's on my tax sheet that I give you. But just thinking ahead, that's what that is. And so what we do is we do projections. So I'm thinking of one person in particular, and this is back when the age was 70 and a half. And I showed them, I said, look, when you become 70 and a half, because this is going back a few years, I've been working with them for like 11 years. I said, you're going to have to take out this much money out of these accounts, because they're the type of people that put all the money away in these tax deferred accounts.
Yeah.
And they looked at me and they said, well, we don't need that much. No, we're not going to do that. I said, well, you kind of have to. I said, you can reinvest if you want to, but you're paying the tax. So you got to take all that out. And then so that was one of those things that make you go, And so then I said, what you could do is, why don't we start doing Roth conversions now and reduce that amount? And so over the years, we have taken out Roth conversions. We filled up their bracket. They're retired. So we filled up to 24% bracket. So they went from 22 to 24%, not a big deal to them. And we just filled that bracket up with Roth conversions. And on top of that, we've tried to time it. Can't be perfect, but we try our best in 2020, 2022, when the market has big drops, great time to do Roth conversions, right? So now so their Roth account has greater returns than the traditional IRA. And that's great because all the Roth money is theirs. And so the traditional IRA is still doing quite well, but they're in partnership with Uncle Sam on that. So it's RMDs. That's what that means for you, the person that has to take the money out. And then I don't know if we want to talk about this now, but then from an inheritance standpoint, there's another kind of can of worms to open with that if you inherit one of those, which people listening probably do inherit those.
Yeah, let's definitely come back to the inherit. I just want to ask a little bit more when it comes to the conversions. So what would be a circumstance where, well, you gave an example, and I think it was a good example, somebody that has a substantial amount, they're not necessarily going to need all of the money that's now going to be a required minimum, amount that they're going to have to take out of those accounts. So you're looking at that in advance and saying, okay, this is going to be coming up. This is what you're going to end up needing. You're converting them. How does that conversion work? You're pulling it out of a traditional IRA. You're putting it into essentially a Roth, or converting it into a Roth. What kind of a penalty are you paying in order to do that? And then the advantage is that you just won't have to pay any taxes on that income.
Right. So there's no penalty to convert it. You can convert it anytime. It has nothing to do with your income. It has nothing to do with your age. Anybody can convert an IRA, a traditional IRA, into a Roth IRA anytime they want to. When you convert it that year, all the conversion you did, that's going to be added to your income for the year. So that's where you can be, within a strategy, you can be tactical, right? So a year that maybe you have low income would be a good year to do a Roth conversion, assuming that you've got some other form of cash to kind of make ends meet, right? So you do got to pay a tax when you do the conversion, or at least it's added to your taxable income. So that's how that works. And the other thing I'll point out is there's a couple of different 5-year rules around Roth. So you got to be a little bit careful there. For example, let's say you opened up a Roth at a young age, right? Well, a 5-year clock starts to tick. And so once you've had a Roth IRA open for 5 years, doesn't matter if you depleted it, you just want to have a record that you start opening up the Roth in 2009 or whenever you opened it. Well, you've had one open for 5 years, then you can take all the money out tax-free, including the growth, assuming you're 59 and a half or older. So prior to 59 and a half, so for the young folks that are out there, maybe you got grown kids that are 25 years old, I love putting young kids into a Roth. They're not at their highest income yet, probably, or shouldn't be. And so they can get the cost basis back out without a penalty and without a tax. So there's opportunity costs there, but still, that's why Roths are pretty nice. A traditional IRA, you're not able to do it like that. So same thing when you convert it. So now we converted it, and you're like, well, what if a year later I want to take money out of the Roth? And I converted it a year ago and I just opened one up. You can take the cost basis out. You just can't take the growth out. So, and with Roth, it is FIFO, first in, first out. So you're okay. Not like an annuity. That's different. So that's how it works.
Okay. No, very interesting. How about if you were inheriting in one of those accounts?
Okay. So an inherited account, this is where it's extremely important. Whoever is doing those beneficiary forms, whether you're doing it self-directed or you have an advisor, please make sure those are updated the way that you want them. If you don't want your ex-spouse to be on there, make sure it's updated, right? Or if you have an age, unfortunately, sometimes people, whether it's kids or parents, they're no longer here. It's just good to update it. That's why you have contingent beneficiaries. So let's say you inherit an account, a traditional IRA, or it could come from a 401k. So, and you're not a spouse. So we're talking about non-spouses here. Spouses have special rules. But if it's a grown kid, let's say, and they're not, they're more than 10 years from the person that they inherited it. So this came with the Secure Act. So they're at least 10-year difference younger than who they inherited from. So let's think of a parent, right? So what will happen is you're going to have that account be completely emptied within 10 years of inheriting the account. So, and then it depends if you have to take money out each year. We're talking about traditional IRAs. So if the parent was already starting their RMDs, they already had to start taking those RMDs out. That means the person that has inherited the account, will have to take out some each year. And there's a calculation for that because it has to do with it has to do with your age. So you'll have to take out small amounts each year. Now you can take out more if you want to, but you got to take the minimum out during that. And then by the end of the 10 year, you have to have it completely emptied for a traditional IRA or a pre-tax 401k. Now, if you're, let's say there are some special situations. So I got a situation where there's two brothers and inherited it equally. One of them is in their high peak earning years. So they're trying to take out the minimum amount at this inherited IRA. The other one, was in the service. So they're on disability. They're able to stretch it like the old rules. So they're able to stretch that out over their life expectancy. So they don't have to have it completely emptied over 10 years. So there are some exceptions that would allow you to take it out over past the 10-year mark. Now, one other thing too is Roth IRA. So if you inherit a Roth, still a 10-year rule, but the difference is you don't have to take any of it out until the year 10. You just have to have it completely emptied at the end of 10 years, and it's tax-free. So could you take it out? You could take it out if you want, or earlier if you want to, but it's kind of cool that it's all tax-free when you inherit Roth. So there are deathbed conversions that happen. So
I was going to say, my wheels were turning there.
Yeah, they're like, hey, I'm going to lower tax rate than you. I want to do you a favor. I'm going to do you a solid. I'm going to convert something for you. So it does happen. Also on that, so let's just say you don't want it, don't need it. Okay, you can say, I don't want some of that, or I don't want any of that. You, the beneficiary, cannot decide where the money goes. It's going to go to the contingent beneficiary. Who else is the primary beneficiary on it? So, that happens sometimes. Sometimes it's the female, and she's like, I don't really want it. I want my kids to have it. And so, and maybe they're the only beneficiary on there, or maybe she's 50%. Then it could go if there's the contingent on there. So that's why the grandparents, if they want grandkids on there, they need to put them on there as contingent beneficiaries. Otherwise, you're going to have to do some additional planning.
Okay. No, that's a good point. It's something that probably doesn't get thought of. Sounds like it's kind of, that seems to be something, I mean, obviously you see this, every day, but this is kind of a common thing, I would think, that people still have those types of accounts when they pass. And so people are inheriting this all the time. So this is truly something that I think the audience can, I haven't had to deal with it on this end yet, but thank God. But at some point,
Yep. And it's going to continue. It's not, there's a wave of money that is changing hands. Now, on investments, if it's a brokerage account, like a transfer on death account, I call a non-qualified account, those get a step up in basis. So those are beautiful from an inheritance standpoint. So somebody like, oh, I've had Apple forever, and I only paid, whatever, $100 for it. And then when they pass, it's $1,000 a share, right? So the person inherits it, gets it at the what the value is at date of death. So the ones that aren't inside those IRAs can be pretty nice things to pass on.
Okay, yeah, I hadn't thought about that either. Are there folks that look at that and well, I guess in order for the step up to make sense anyway, they would have had to have had that account open for X amount of time, to recognize that. But okay.
Yeah, or people, when they take the money out of the IRAs, right? Sometimes that require minimum distribution, they don't have to spend it. They can absolutely, but they want to just move the stock position or ETF position over to a taxable account, if they don't quote need it, they can do that, right? They could do that, and then and then it just accumulates and they pass it on.
Okay. Let's maybe go a little different direction for just a bit, as far as, maybe folks that are just getting started, just graduating from college. What are some things that you see that, we all have that moment where it's like, I wish I had done that, years ago kind of thing. And so just curious as to some of the recommendations or things that you would tell somebody who's maybe just graduating, what are some things they can do to set themselves up?
Right. Yeah. So I actually have my oldest kid's 23. So she graduated, she swam for 4 years in the workforce, and I didn't know how it was going to shake, but she actually takes my advice, which surprised me. I'm like, oh, thanks. So I've kind of lived some of this firsthand. So there's many things out there, but the most important thing is the behavior, right? It's the habits. That is most important. And so with respect to investments, if they've never invested before, I'm not a big fan of a brand new investor going 100% equities, just in case they have a bad timing, a bad experience, and then they don't want to invest anymore. So I'm a little leery about that. But I'm not making recommendations. I'm just telling you what I've experienced. You may want to kind of ease into the risk spectrum, but it's all about developing habits. So if somebody can meet the match at their employer, great, or put 10% away, absolutely get an emergency fund that is, principally protected, probably a money market, maybe a high yield savings. I love those, right? Or really, if you think about it, you could actually do at that age a Roth IRA. So what's cool about that is you can take the money out if you need it because it's the cost basis without tax. Now, so it really depends on their income. So, something else is like kind of quirky but cool. A lot of times they're single, they're out there, they're working, and let's say you're making $65,000. Well, by the time you do your standard deduction, and if you're putting any kind of money away into a plan or something like that, your taxable income is going to be below a long-term capital gain tax rate of 0%. So some people, not all, but some may have had like what we call a custodial account. Maybe a parent or a grandparent had that. So that would be the time or maybe you didn't get a full-time job till midway through the year. So that's the time you want to sell that, realize the gain at 0%, and you can buy it right back if you want. If you like that stock, just buy it right back. And then I said that one time and somebody said, well, what about the wash rule? I'm like, no, that's for losses. So you can realize a gain anytime you want and buy it back. So that's because you're realizing the gain. So you just got to be careful. Like, are you at a 0% long-term cap gain rate or 15%? So student loans, obviously that's a big one. So you got to think through that. What makes sense there. I feel bad for the people that got super confused a couple of years ago. Like, I thought they were going to pay my loan, or I thought they were going to pay $10,000. No, they're not. So you just got to you got to think through that. So I think that takes its own conversation. But definitely steer clear of the high credit card debts, right? And don't get an auto loan that you can barely afford. It's really about habits. See what you can do. The other thing I'll mention, if the parents share, hey, I got a 529 for you and you didn't use it, I thought you were going to go to grad school, or you went to a state school, I thought you were going to private school, whatever it may be. If the parents have had that for 15 years or longer, if they want to, they don't have to. They can always change the beneficiary to somebody else, another sibling, cousin, who knows. But if they want to give it to you, the same beneficiary, they can do that because they've had it open for 15 years into your Roth. So kind of cool, that they can do that. Now you still got to earn money. So you can't not earn money and get that to happen. But as long as you earn enough money, so if they give you $5,000 into a Roth IRA, as long as you made more than $5,000 that year, you can do it. What else on that? And then you can't go past the limits. So you can't have them give you $5,000 and then all of a sudden you contribute, $7,000. You're going to be past the limit. So Roth IRAs, you have limits on how much you can put in. So that's kind of a cool thing, just if people that are young, hear about that's something that's out there. But yeah, put money into your 401k if you have it. They probably have a Roth 401k provision. Might think about that. HSAs, love those, right? Put money in those HSAs. You get a deduction. You get to take it out tax-free for qualified reasons, medical related, and you don't have to take it out. You can just let that thing grow, and pay for your medical out of pocket, or keep doing healthy habits so you don't have to spend that. And that can be a very big deal when you're at retirement age and you got an HSA balance of $200,000. That can be super helpful for out-of-pocket expenses when you're at retirement.
Yeah, that's a good point. You don't have to. It's a lot of times people look at it, or at least I did know when I first got mine. I looked at it more of like, okay, this is how much I have for the year to spend, but it can continue to accumulate and just grow, and you can use it for that future opportunity.
Yep. Yeah, absolutely. You can invest it if you want.
Yeah, exactly. How about when you talked a little bit about long-term care and some of those considerations, maybe just for the audience, because it's one of those things I find that sometimes people don't want to think or talk about that. It's difficult imagining, that you're going to need somebody else's care at some point, that you're going to get to that spot. But, it's coming at some point for everybody, and just how we each handle it is going to be different. But tell us a little bit about some of the considerations that people may need to, think about when it comes to that.
Right. So I always like to look at statistics, right? So if you're 65 and older and the odds are more in favor that you'll need long-term care in your lifetime, I think it's probably prudent to have some type of plan. Doesn't mean you need insurance necessarily, but you want to start to think about it and have a plan. Now, some people need it before 65, right? But oftentimes people need it in their 80s or 90s or 70s, right? So that can happen. And so it's a very common thing. And so don't think nursing home, right? That is a form of long-term care, but think, oh, I want to stay in my house, but I need somebody to come here 3 days a week, right? That can happen. Or I'm at an independent living and I got somebody coming in, or I'm an assisted living and I got somebody coming in. So those are some of the things that happen. So it's usually it could be a graduated scale. And at some point, it could be in a nursing home. That could happen. And that is very expensive. So you got to look at your state and see about it. Medicare is not going to help you that much on long-term care. So, and then people say, well, I'll just use Medicaid. I mean, if you got some good assets, probably not. There's a 5-year look period. And then indeed, in some cases, you may not want a Medicaid bed, right? You might want to have better choices. So it's something you gotta think about, right? And do you want, you're like, oh, my kid's going to help me. Okay, well, they're probably not a trained person, so that's okay. Or the spouses help each other out. I mean, I've seen it, firsthand, and unfortunately, on both sides of the family, and it can really wear you out taking care of the spouse, and so how do you qualify, per se, for long-term care? You got these activities of daily living. There's 6 of them. So think of clothing, bathing, consonant, transferring, right? Bathing. So you got these 6 that are out there. And then, what if you're cognitively impaired? Well, that would be, just that alone would be a qualifying event. You wouldn't need the 2 of the 6 activities of daily living to qualify. And so I say qualify, that just means, to be able to get, Medicare does help you for like 20 days, right? So, if somebody's in their 50s, and they're like, well, you know what? My term life insurance is about to expire, and I wouldn't mind knowing, what does this even cost me if I want to get one? I want to get a long-term care policies. And so they had a bad rap going back a few years, as they should, because they didn't know how to price these things. They just didn't. And so there was always a winner and a loser. Sometimes the insurance company won. Sometimes the policyholder won. I've seen that before. Like, tears of joy almost. Like, what do you mean? And both parents get $10,000 a month? Holy smokes. So it had this inflation rider, and that's why these companies could stay in business, right? And then you also see the flip side, which is like, man, my premiums go up every year and I can't even afford it. And now I get nothing to show for it. So what happened is the life insurance companies said, you know what, why don't we do permanent life insurance? So I'll give you an example, a $250,000 permanent life insurance policy. And why don't we let the policyholder get up to $5,000 a month to pay for it? So you can do that. And that way you're not going to use it or lose it kind of deal. If you never used it for care, at least you have a $250,000 death benefit to go to your beneficiaries tax-free. Is that your spouse, is that your kids, whoever, is that to the estate? So those are more popular now, and there's a bunch of different ones, and there's some are more levered towards long-term care, some are more levered towards life insurance. But I can see the popularity there. Some people can't get insurance. They're not, the health is deteriorated to the point that they can't get it, or maybe they can't afford it, right? And so you want to, if you're not going to use the leverage of an insurance company, then you need to earmark an asset, I think. That is a good idea, right? So whether that's a real estate property, whether that's part of your investment plan, it's a good idea to earmark some of that for care needs.
Yeah, for sure. What is a typical age when people are looking at the long-term care? At what age do people normally look at that, or should start looking at that if they're potentially going to get a policy?
Yeah, if they're going to get a policy, I would say you want to get it when you're 10 years out from retirement. That's the way to do it. That way, maybe you can pay for it out of cash flow, right? And then after 10 years, you got something that's you don't have to put any more money into it, and you have hopefully an inflation rider there. A lot of times the most common one I see is a 3% compound inflation, and so that's the most common one I've seen. I've seen some that do a 5-year pay. Some people do a single premium pay, which is they're already retired and they just use an asset to pay for it. But most common I see is 10-year pay. There are some that allow you to pay for it while you're alive. And so that fits well with those that have a pension. So I've seen those, right? I got the pension coming in. That's going to kind of help fund it. I wouldn't say, folks don't do any long-term care only plans, right? So if things are really tight, you're still going to get, a little more leverage there for long-term care needs. So there's special situations where that might make sense. You just got to understand that it's going to go up, those premiums over time. But for a business owner, maybe they can get a tax deduction on the long-term care piece. So there's certain situations where that is. But generally speaking, 10 years out is kind of a good way to go. Doesn't mean you can't do it at retirement. You certainly can. You just have to use some of your assets to pay for it if you're going to use insurance.
Right. Yeah. Makes sense. Well, no, this has been great. Ray, is there anything else that you want to make sure to convey to the audience, or something that we maybe didn't get to that you were hoping we'd be able to talk a little bit about?
Yeah, man, there's so much out there. There really is. I mean, the thing I would say the most is come up with a plan, right? A really good plan, and then execute on it. And don't make it so rigid that something happens and it's painful to do something about it. And two things happen oftentimes in life. Sometimes it's a problem, and then we got to fix it. And other times it's opportunities. And so you want to be able to take action and go for that opportunity. So put that in any of your plans, whether you're young or whether you're already retired. Really important. Can somebody do this on their own and they're in their 30s and 40s? Absolutely, you can do it, right? You sure can. If you're a business owner, sometimes it might be good to have somebody, kind of an advocate on your side, just from a networking standpoint as well. But certainly your W-2 out there, go ahead and just get after it. Put some money away, have some kind of plan, and try to stick with it. And definitely avoid those high interest credit cards. Avoid that. That can be painful to building wealth. So those would be some of the things. I mean, there's things we didn't get to, but there's just too many things out there. So I think, we've kind of covered that. Yeah.
Well, I think, kind of ending on that fact that there are so many things out there, I think it just kind of, reiterates that having a professional in your corner, like a certified financial planner, is huge, because you're exposed to, this is your job, about these, you make it your job to know about all of these things. And, there's a wide variety of things out there, and, so it's always good to get professional help on it. So, on that note, how can folks find out more about Southeast Wealth Partners and more about you?
Yeah, you can just go to our website, southeastwealthpartners.com. That's our website. If you have questions and you just want an answer, you can always email us. That's info@sewealthpartners.com. My team would get that. We also have a podcast, so if anybody wants to listen to that, we cover some of these topics in a little bit of detail. So those would be some of the ways.
Perfect. What's the podcast called?
Executive Retirement Compass.
All right, perfect. We'll put that in the show notes as well. And then I've got two other questions for you, Ray, that I ask every guest. One would just be any advice you'd give somebody who's maybe just starting out in their investment journey? I know we kind of had a question like that throughout this thing,
Right.
but just any advice you'd give somebody who's just starting out?
Yeah, I would say, like I say, have an emergency fund. So you want to have that. So if something comes up, you've got the cash there to be able to put that fire out, and then meet your match with the 401k and start saving. And if you have a either a Roth IRA that's self-directed or a brokerage account, don't. I wouldn't be picking out stocks. I would just go with a broad index. Go with some of those broad index to start with. Once you've accumulated, a certain amount of money, then maybe get into the stocks. But that's an easy way to be diversified. That's probably what I would think would be a good idea.
Yeah, I think so too. On the index piece of it, I think that it just makes sense. It's so hard to pick stocks, and even the folks that do that for a living, it's still a challenge when you look at the statistics. How about a book recommendation? Does not have to be finance related. Certainly can be something you've read that's been impactful.
Yeah, so I listen to a lot of podcasts. So as the kids got older, I was like, oh man, I got more free time. I'm not, at the soccer fields and the swimming pools and things like that. So my hobby is actually listening to experts on planning and reading books on it. So I feel a little nerdy saying that, but so it would be a book like that, and it's the Retirement Planning Guidebook. I think I got the title correct. It's Wade Pfau. So Dr. Wade Pfau is I think, very, very scholarly. So, and the third edition's pretty good because he got rid of a lot of pages that were unnecessary. So the third edition is quite good. I think that's a good one. Just on the regular book side of things, that impacted me way back is a Stephen Covey book, The 7 Habits of Highly Effective People. I love that book. That one really, meant something. And so something kind of similar would be Atomic Habits. That's another great book.
Yeah.
That's a great book. That's a little more newer. I might probably like that one a little better, Atomic Habits. Yeah.
Yeah. All great recommendations. Have not heard about the first one, so I'll have to check that one out myself.
Yeah.
Ray, this has been great. I appreciate you being a guest on the Wealth Flow, and I think we'll call it a show.
Awesome. Thank you for having me.
Thanks. All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.